It's Tuesday, August 13th, 2024, and it's 6 p.m., at least where I live. So welcome everybody. This is our office hours Q&A. It's been an eventful week. We had our Summit Strategy Sessions workshop last week, and we launched our new community stuff where all of our content and tools and templates and workshops and courses, all that's going to be in the communities. There's two levels. We'll get into that later, but it is pretty exciting for me because I have actually been thinking about this since like 2016,
Wow.
maybe 2017, as far as how to turn what we do and just the giant masses of information in my head into something that people can actually consume. Because part of my problem is that I am all out of time. So, which sounds strange, but it's a real problem. So, being able to put things down in a way that people can tap into them at their pace and when they want is actually super useful. So, I kind of wish I'd done this 5 years ago, but we are here now.
Right, right.
All right. For those of you who don't know, I'm Neil. We've got Serena on the line. We
Hello,
are
hello.
we are the I'm the founder and chief tax strategist here at Tax Sherpa. Serena's our ops manager. She leads the team and makes sure all the things get done.
Yes.
Uh, the quick version of my story is that I realized early on that the corporate world was not for me. And so I started doing my own thing, trying various things in the world of entrepreneurship. Some worked, some did not. And in 2007, I started getting nasty letters from the IRS saying I owed them over $1.3 million. And like most people, when they get a letter from the IRS, I ignored it. 70% of all IRS notices do not get a response. And I was one of those 70%, so I understand. However, after a while, if the number's big enough, they will start going after your stuff. And at that point, I was like, oh, I got to fix this. So in 2009, I started fixing my own issues and ended up apprenticing under my mentor, who was a former Wall Street tax attorney. He used to handle the specialists on the New York Stock Exchange with the firm he was at. All kinds of fun stories out of that place. But since over the last 15 years, done 50,000 tax returns, billions of dollars worth of client revenue, and we save clients millions of dollars every year. And so in 2019, I went out on my own and founded Tax Sherpa. And our mission here is to help my tribe. So all the people who couldn't fit into the corporate world, it's not for them, whether by temperament or choice or whatever. Those are the people that Tax Sherpa aims to serve. And, the goal is to get your quality of life back. And, part of getting older, I think, is focusing more on time. Because, you blink and kids are growing up and you're 20 years older. I had a buddy of mine message me on LinkedIn, like a couple of buddies. We were roommates back in college, and good friends and everything. He went off into the Air Force, and I did opposite. But so he hit me up on LinkedIn, and I was we were just chatting, and he had said that he retired from the military. I was like, wow, because standard retirement, is a 20-year process. So, and I was thinking back, has it been 20 years since we graduated from school? It's like, yeah, it actually has. And it just flies by. So, you know, so time is the most important aspect. And, what I'll go into on the next slide here. The quality of our questions determines the quality of our life. So what is the real question that's related to time here? And that's my question. So it goes to the root of the problem with overpaying on taxes. Because when you overpay on taxes, you are spending your time not working for yourself, not working for your family, not working for the community. You are working for the government on those days. I'm going to move your head over here on the stream so that you're not covering the thing. But yeah, so average taxpayer that we run into is overpaying by 20%, and that means 20% of their gross income. So if you are paying, when you factor in the income taxes, self-employment taxes, the state taxes, the payroll taxes, the additional Medicare taxes, all those things. We find people are generally overpaying by about 20%, and just a kind of a broad average. And if you work that out through over 365 days, that's 74 days a year that you are working for the government that you don't have to be. And for me, that is just a criminal waste. So, our goal is to get that time back for our people, for our tribe, so that they can improve their quality of life. And you can do whatever you want with those 74 days. Most people, the people we talk to, are pretty go-getter-y. So they're going to be reinvesting that time into their own business to grow faster and bigger. And so that's great. That's certainly a choice. But if you just want to hang out on the beach, that's fine too. So with that said, let's talk about all tax questions. I have the answer to all tax questions, and it depends. So it depends is the actual answer, because it really does depend. It depends on what we call facts and circumstances. What is true for you is not necessarily going to be true for another person with the similar, what sounds like the core issue, but all the things around that are not. And my go-to example currently is the 1099Ks. So I know I harp on this every week, but what it is that there was a rule, or there was a law passed during COVID which changed the 1099K reporting requirements. So under the old law, if you used a payment platform like if you accepted Visa cards or American Express or whatever, and you had at least 200 transactions during the year, and the total dollar volume of the transactions was at least $20,000, then at the end of the year, American Express would send you a 1099K. It's a third-party reporting statement saying that, okay, we, American Express, have processed X number of dollars in this many transactions on behalf of Joe Taxpayer or Joe Taxpayer's company, whatever, and with this EIN and all that. And the IRS uses those to make sure that all the revenue is being reported correctly. So whatever number is at the top of the tax return for that business, it's got to be at least as much as is on the 1099Ks. So that was the old rules. New rules are that number of transactions doesn't matter, and the total dollar value to generate a 1099K is now $600. And so this was supposed to go into effect 2 years ago, and each year the IRS has come out at the very end of the year saying, okay, we're going to postpone this another year because we're working on implementation with industry partners, blah, blah, blah. And the reason for that is because they're expecting 30 million of these forms to be generated with this rule change. And it's going to impact a ton of people that aren't going to know what to do with it. Because if you got a Venmo, or if you got 10 Venmos over the course of a year, and the total added up to more than $600, you're going to get a form from Venmo. Or Zelle or PayPal or Stripe or whatever, any of the platforms that process payments, which includes Airbnbs and VRBO. So it's going to affect a lot of people, and a lot of that is not income because it depends on facts and circumstances. So if you go out to dinner and you pay for it on your card, and your friends or whoever Venmos you the amount to cover their portion of the bill, that's not income. That's a reimbursement. If somebody gives you a gift, that's not income. That's a gift. So somebody gives you a loan, that's not income. That's a loan. So even though the same $100 might hit your account, that doesn't mean it's anything. Part of the tax return is declaring what things are, to the government and how they're to be taxed. So we're still waiting on the forms for how we're going to handle the 1099Ks that are not income. And the rumor is that it's going to be a Schedule 1 adjustment, which is, where your IRAs and student loan interest and all that kind of stuff goes. But, we will see. But it's a perfect case of it depends, because, okay, you got this form from, I'll pick on Venmo some more. You got this form from Venmo saying that you received $3,000 this year. What is it? And you're going to have to declare what it is and make sure that everything matches up on the tax returns so that it doesn't generate a mismatch error. And those will automatically generate letters from the IRS that you don't want to get. So ideally, we want to avoid those issues. So that is the answer to all tax questions. It depends. We can wrap it up here and go. uh, but no, I know people have actually questions, and Serena has a bunch from people that have written in because we get questions every day from all kinds of people.
Every
Uh,
day.
so what do we have on tap here, Serena, as far as
So
questions this week?
we have a 1065 question.
Oh, okay.
Someone wants to know, in your experience, what are some of the most common errors or oversights you've seen on Form 1065 filings, and how
Oh,
did you
okay.
address them?
Yeah. So there are a lot actually. So a 1065 is a partnership return. So if you have like an LLC that has more than two or more than one, so two or more members, the default treatment is partnership. Um, these days, we don't see too much other kinds of partnerships. So like in the old days, you a partnership did not or still does not have to be a formal legal entity. So you can have a general partnership between two people that is not anything as far as state filings go, but you could register a tax ID number. It's a really bad idea to do it that way because now we have LLCs. So LLCs are super great because they limit liability, whereas general partnerships do not. Here's tip number one. If you go into partnership with somebody, at the very least, create an LLC for it. So that's free advice for everybody because you can get into massive trouble. Not tax-wise so much, but legal issues and liability issues. The LL in LLC is limited liability. It's key words. Okay, so a partnership that files a tax return, it's a 1065. It is somewhat similar to an 1120S in that it is a business, it files its own tax return, and then the end results flow through to the owners. So the owners each get a K1, a Schedule K1, which is kind of their statement of their share of the profits and the credits. And, there's like 20 different boxes on the K1, but usually only a few of them are used. So what's interesting about an LLC, or sorry, what's interesting about a partnership is that in most cases, the income carries self-employment tax consequences. So uh, a partnership and a Schedule C self-employed is kind of the same thing. It's just how many people are involved. So Schedule C is just one person, sole proprietorship, whether it's in an LLC or not. And a partnership is kind of the same thing, just with two or more. And so if you get a K1 and it has $50,000 of income, generally you're going to pay income tax on the 50,000, and you're going to pay self-employment tax on the 50,000. So self-employment tax is the substitute for Social Security and Medicare, which is the payroll tax that W-2 earners have to pay. So that's issue number one, and making sure that is actually correct. Issue number two with 1065s is guaranteed payments. So we had a client who it's constant argument. So he was our client, and then he was in a 1065 with some other people doing a joint venture where he was brokering stuff. And so the way the 1065 was written up was that he was getting guaranteed payments. Now, guaranteed payments are kind of a replacement for salary. So we are guaranteeing this payment to this person, an owner usually, and that is going to carry self-employment tax as well as whatever comes through on the profit line. So it's a double hit in that way. But the thing about guaranteed payments is that it's in the name; it's guaranteed, right? So, what in his case, it was not a guaranteed payment because the money wasn't guaranteed. It was a commission essentially, and so we went back and forth many times with the other tax firm. They said yes, this is right. I said no. Here's the instructions. Here's the code section. Blah blah blah. They said they didn't care, and so he ended up having to take a tax hit because of that, which upset me greatly. Now, it wasn't large in his case, but it's still the principal thing really annoyed me. So we see errors in guaranteed payments a lot. We see errors or issues in the 199A treatment, and that is the qualified business income flow throughs. So part of the Tax Cut and Jobs Act That was Trump's tax reform, created this concept of qualified business income, and there's a special deduction associated with it for flow through entities where you get a tax break on flow through income. Calculations on that are often done wrong. It's not as That's not as big a problem as it used to be because the software has kind of caught up at this point to doing it correctly. Um, we see one issue that actually doesn't have a big effect, but people get confused by is the K3. So K3 is a new form, kind of, it's like K1, K2, K3. So the K3 is for international kind of income. And the vast majority of partnerships that file 1065s do not need to file a K3 because they're just domestic. So there's an exception to filing that if all of your income and all of your expense is domestic, which is like 99% of partnerships. So, but a lot of tax preparers don't seem to care, or they don't check the box on their software. So a K3 gets generated automatically, and all it just says that okay, this amount of revenue came from the United States. Great, it's not anything, but it adds confusion to the whole thing. And then the biggest issue with 1065s, and we actually just had this happen with somebody, one of our clients who received a K1 on Monday, I think it was, what is capital accounts. So capital accounts and basis are major issues for partnerships. Basis is also an issue for S corporations. But basically, it's a measurement of how much investment you have in the business. And there's a lot that goes into it, and there's differences between partnerships and S corps and what counts for basis and what doesn't. It's too technical to get into here, but basically, it's a measure of how much money you have in the company or in the venture, and or money at risk. So debt can play an issue, can play a part in it. And if you are negative on your capital accounts, or on your basis, then that can have tax consequences. And it's just something that gets screwed up all the time. And we see this both in partnerships and in S corporations, where it's just not tracked properly. And when the tax returns are done, a lot of times, a number just gets thrown in there that we have to reconcile on our end for the client. And I've seen it, I don't know how many times, constantly. So, people contribute property and don't track it. Like we see a lot with real estate investors. They'll buy something in their personal name and then deed it over into an LLC. It's like, well, that's a capital contribution. You got to track that. And that's going to go into your capital account and your basis. So it's a major issue that is ongoing, and there seems to be no end in sight. So that's the biggest issue with partnerships. So if we had to rank them, I would say capital accounts and basis, self-employment issues, then guaranteed payments, and then all the other stuff. Yeah, there's lots of check boxes on the 1065 on pages 2, 3, 4 that get messed up, but that's usually not that big a deal. The IRS doesn't even read those, to be honest. So what happens is we had a case with a client who operated under one LLC and then had ownership of another, and so we included it on Schedule G, I think it was. It's on page 2, whatever it is, of the 1065. And what happens is that you list the name of the entity that the partnership owns, and what percentage and what type of entity it is, and the tax ID number. So that's all listed there. And then he got a call from the IRS or a letter or something saying, "Hey, so and so hasn't filed tax returns." It's like, well, yeah, it's part of this one because it's listed over here. And it doesn't show up on the transcript, the automated transcripts, because the only things that show up on the transcripts are like the line numbers, and so the additional schedules and everything just aren't there, and so they didn't see it. But even though it was on the tax return, so I guess that's another issue. But so there are lots of issues. Is the short version. But yeah, basis is by far the number one, basis and capital account, and then the self-employment issues. So I don't know. I know that's a little bit meandering, but does that make sense? Oh, Serena, did we lose you?
I'm here. That makes sense. Sorry about that.
Okay.
So that answers that question. I have another question about advanced tax planning, right?
Sure.
A client wants to know, have you implemented any kind of sophisticated tax planning techniques for high net worth individuals or corporations
Yeah.
in your experience?
Yeah. I mean, yes is the answer, but
Okay.
so there's all kinds of different tax strategies. Um, there's there's what we internally call the workforce stuff, which kind of applies to every business. There's tax credits to be bought and sold. There's unique strategies that are particular to certain industries. It's like restaurants; they have the tipped wages credit. Um, Crypto companies, we've got a couple of those. There's some special strategies that can be employed for cryptocurrency specifically because of the way the IRS deemed it to be treated as property. Um, so yeah, I mean, we had one large client of ours that we saved $6 million with one strategy. So yeah, there's there's stuff to be done. The difficult part about the more advanced strategies is that they are so situation dependent that it's hard to give um, broad kind of generalities about it because it's not general. It's specific to this situation. Uh, so there's a whole bunch of them. There's companies you can buy and sell. There's like mineral rights trusts that you can get into. There's tax credits, like I said. Um, there's a lot around charitable foundations and things like that. So I mean, yeah, there's all kinds of stuff out there. But yeah, the short answer is yes.
Okay. Understood. So we have another question, and it's about a divorce, and a client is going through, well, divorce is finalized, right?
Yeah.
And the child was in and out of a household between the mom and the dad, and they're trying to figure out who should claim the son.
Ah,
Uh,
so
so I have a
th-
question on that.
yeah, so this gets sticky.
Okay.
So there's kind of three answers. So there's the IRS rules, there's the court rules, and there's real life. So
Okay.
the IRS rules are that whoever the child spends 50% or more of the time with, that's who gets to claim them as dependent. Um, However, oftentimes, who gets to claim the tax credit for tax purposes is part of the negotiation of the divorce and will be spelled out in the divorce decree. So, what happens is that these agreements are depending on how the people involved are with each other. Um, they're sometimes not followed, and we get into fights after the divorce. Um, so that's if that becomes an issue, it can get difficult because if the child lives. So let's just say the example is that child lives with mom, but dad is it's his year to claim the the tax deduction, and mom claims it anyway. So under IRS rules, mom's right, and if dad tries to claim the child and the IRS does an investigation, they'll say, okay, well, who does the child live with? And they go through all the different tests and everything and say, oh, it belongs to mom. And then dad says, but the court said it goes to me. And the IRS says, we don't care because we are not beholden to your state court, whatever. And they are correct. However, dad can then go back to that state court and say, hey, she got whatever, $3,000 for this kid. I should get that $3,000. And the court will side with him. So there's like a competing jurisdictional issue between the state and the federal when it comes to divorce on these kinds of issues. So the real life answer is that the court ends up being right because that will be the last place they end up. But it can be quite painful to get there if people are not, you know, working well together. And since they got divorced, oftentimes they're not working well together.
Right. Understood.
You know,
So
it's
true.
so so yeah, it's I've seen all kinds of issues. Uh, you know, I there was one example where uh, new couple comes in, you know, husband and wife, they've got, I don't know, 2 year old or something, and you know, we do their taxes, and uh, you know, they're getting a refund, which is great. Everybody's happy. We put it in the computer, and it was before the IRS had opened for filing that year. So, you know, the IRS announces each year they're going to open for electronic filing. You know, they'll give you a date. Usually, sometimes they have form screw ups and it takes forever, but usually it's like third or fourth week of January, that kind of thing. And so they come in right before that and says, okay, you know, in a couple days when the IRS opens up, we'll submit it and you should get your refund whenever. And so the wife comes back the next day and she says, "Oh, we gave you the wrong account, and you know, here's the correct information for the bank account." And so we changed it. And so we filed the return when the IRS opened, and you know, like 2 months goes by, and the husband calls us and says, "Hey, I still haven't gotten my refund. You know, what's going on?" And so we look it up and says, "Oh, you know, it was processed on, you know, February whatever, and you know, went to your account." And he says, "What account did it go to?" And we tell him. It says, "Oh yeah, your wife came in and you know she gave us the updated information." And you know, he starts going off, and it turns out that she was an immigrant, and they were in the green card process. And he, yeah, I don't know if he followed through with it or not, but he told us on the phone that you know he wasn't going to go through with the interview because you know she pulled this you know nonsense on him. So you know
Oh, wow.
people go nuts over you know a couple $1,000s for a kid sometimes. So it can get sticky.
Right. You can really get like bananas, right?
Yeah, yeah. When it comes to money and family, things can go awry rather quickly.
I agree.
Uh,
So
yeah.
we have another partnership question.
Okay.
So a client asks, we are a partnership that operates in several states. How do we handle tax state filing requirements? Are there any special considerations for allocating income among states?
Yeah. So there's different methods. So you do have to allocate, and generally you're gonna have to file in as many states as you operate in. So the if you're truly nationwide, then it's a whole pain. But you know, if you're in like 2 or 3 states, you're going to have like 2 or 3 state filings that roll up into the federal filing. And there's different allocation methods, and some of them depend on state. Uh, some of them depend on the 3 Ps, which is profit, payroll, and property. So, like, let's say you have a warehouse in one place, and then your operations are in another place. Then the warehouse is an anchoring factor in the allocations, even though there's no money being generated there. Similarly, if you have payroll of people in different states, that could be a weighting issue. Um, so you know, there's you know, a lot of states have slightly different formulas, which can be another issue. Um, and you know, they'll sometimes weight things differently. Like California, like if you sell to California residents, that's one factor. If you ship from a California location, that's another factor. Um, so you know, obviously, California is one of the more annoying states to deal with. But yeah, that's basically it. So you go through the allocation formulas, whichever method you end up choosing, and then you know, it's you're going to pay tax on whatever percentage they end up calculating as your share of your overall in that particular state, uh, and whether there's a state income tax with that or not. So, like if you're a partnership and you have stuff in Florida, then you know it's nothing to worry about. If it's a C corporation, you do have to worry about it. But that's the general approach. So it's just more work basically. And one thing to remember is that you're not going to get double taxed on the same income. So if something gets apportioned to one place, it's not going to also be apportioned to another place. And so you're not getting double hit on the same money. You might get hit higher in a higher jurisdiction, but that'll be on that amount, and then your other jurisdiction will have whatever its rate is. So you just gotta manage all that. And the big thing with that is well, with the property and payroll factors, that's usually pretty easy to figure out because it's like, oh, I've got a warehouse or I've got a office or whatever. That's the property part. Payroll, your W-2 or your payroll provider will know where everybody lives because they have to do withholdings, so that's usually pretty easy. It's the sales that a lot of people don't know. So the so tracking your sales by state is a big issue, and this also pops up in sales tax. If you have a good or a service that does collect sales tax, ever since the Wayfair decision, where economic nexus was created as a concept, then we have 50 different states with 50 different sets of rules as to whether or not you're selling enough in their state, even if you're not located there, in order to have economic nexus, and then you have to pay sales tax on those transactions. And there's some crazy number of like thousands of jurisdictions that have their own sales taxes because like counties and cities and states and Texas has like all kinds of weird stuff with like school districts and stuff like that. Ohio's another school district one. So there are companies like TaxJar and Avalara who have a whole business dedicated to just figuring out and filing sales tax stuff. And so if you're in one of those situations, you can often use their reporting to figure out the weighting of the different jurisdictions for income tax purposes. But yeah, it's just more work, effectively.
Right. A lot of work to do, right?
Yep.
So another partnership question.
Oh, it's all partnerships today.
Yeah, yes. Our partnership has a new partner who contributed property instead of cash. How
Okay.
should we report this on our tax return?
Yeah. So on the on the basis worksheet, there's different line items for contributions. One of them is cash, and one of them is property. So as long as you designate that in the right thing. So here's the thing: when a shareholder or a partner contributes property, it's contributed at the contributor's basis. So let's say it's a rental house. Okay, so I I have this rental house. I've owned it for 10 years. I bought it for 300,000, but over the years I've depreciated it. So now I'm down to 200,000. And then some partners come in and we all want to work together. So I'm putting this asset into the business now. So the question is, at what price are we valuing the contribution? And the answer is whatever the basis is. So in this case, it'd be 200,000. So you got to make sure you do that analysis. Now, if it's something that was bought recently and then just put in, then that's usually pretty easy. Whatever you paid for it, that's it. But if it's something that's been around for a while and has, like today's market price might be different than the price you bought it at, or there's been depreciation or things like that, you gotta figure out whatever the actual basis is that is the basis in the asset that's going to contribute to the partnership. So that's a little bit tricky, but usually fairly uh, fairly rare. Actually, most people just do cash, which is good.
Right, right, which is better.
Yeah, cash is clean. Just here's a number.
Right, that's it. All righty. So we have 1120S question, Neil.
Mhm.
So someone received the IRS notice about
Yep.
their S corporation being questioned due to ineligible shareholder. What
Oh,
steps should we take to resolve this?
well, is it an ineligible shareholder? Is the question. So basically, to be a shareholder of an S corporation, you got to be an individual of some sort. You can be an IRA, you can be an individual, you can be like a tax exempt or trust, but you can't be like another corporation. So you'd have to figure out if that is in fact the case, um, and if it is, then you gotta fix it. And what the fix is going to depend on what exactly the problem is. So as a general structuring thing, you're going to have 1120S's owned by individual 1040 filers for the most part. Uh, Rarely we see other things, but and then anything that is then owned like as a joint venture or anything else, is either going to be a disregarded entity or it's going to be a partnership, because a partnership can have any kind of owner. So usually we'll have a 1065, down here, and then that's owned by an 1120S, and then that 1120S is owned by 1040 owners. So that's it's part of a broader conversation about entity structuring and making sure you're doing it correctly. So it's definitely worth looking into. Um, I'll have to get with you afterwards to see who that was, see what the issue was.
Understood. Another question is, I received a significant amount of stock options from my employer this year. How do I report this on my tax return, and what are the tax implications?
Yeah, so stock options can be done many different ways. Um, and I'm not going to go into every single one, but you know, oftentimes the option itself will not have much value, and that's the generally better way to go, because then you don't have an income event until you exercise it. So an option, for those who don't know, is giving you an option. Usually in the employment case, it's going to be an option to purchase, so it's going to be a call option. So say, okay, we have some company stock. Maybe it's worth something today, maybe it isn't, but in the future, we're expecting great things. So we're going to give you these options, and you can buy our stock at $100 a share. Now, right now, it's trading at 20. So you're not going to exercise your option right now, but in the future, our hope is that things go well and it's worth 1,000. And then if you're at 100, then that's great, right? So the option itself, as the granted contract, is not valuable, when it's granted, usually. And in that case, there's nothing to report when you receive the option. Then when you exercise the option, then you have an event at that point. And so let's say, I exercise my buy price at 100 and I receive, the stuff at 1,000 and I sell. Now I have a gain from 100 to 1,000. That's $900 in gain. And then that gets reported either as a short-term or a long-term gain, depending on how long the holding period is. So yeah, it can be done lots of different ways. That's the one I just outlined is the best way, just because it minimizes the taxes right now and pushes them off into the future when when you actually sell the stock and get some money. But yeah, stock compensation can get all kinds of squirrely depending on how it's done. Our most common thing that we see is RSUs, where an employee, usually at tech companies, they're pretty famous for doing this. They'll get a base pay of whatever, and then they get RSUs, restricted stock units, and that gets included as part of their payroll. So it gets included in their W-2, and they've already paid some withholding taxes on it, and they pay Social Security, Medicare on it as well. Now, the issue with RSUs is that the brokerage companies will often sell off like 20% of the stock in order to cover the income taxes on the payroll component. And that's fine, except for a lot of times 20% is not the right number because it depends on what else is going on with that taxpayer that year. If they're in the 37% bracket because it's a good year, stock bonuses were fantastic, blah, 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 then selling 20% is only half of what you needed to sell in order to cover the taxes on that. So not so much this year, but a couple of years ago when the stock market was more active in IPOs and stuff, we had a number of clients who ended up upside down on their stock grants because they received their RSUs and some was sold off automatically on their behalf for the withholding tax, but it was not enough. And between the time when they got the stock and the time we were filing taxes, the stock went down. So they were holding on to the stock. They had thought that all the taxes were covered. They weren't. And then when they go to sell, it's like, oh, well, now I have to sell more because it's worth less. So in order to get the same dollar amount, I now have to take this hit. And when you have a capital loss, you can't go backwards and apply next year's loss to this year. So you can only roll forward, and that can be a big issue. So be aware of what's going on if you have stock compensation, whether it's options or regular stock or whatever. just be aware. Make sure you talk to us, throughout the year to see what's going on to make sure that the numbers are where they should be.
Alrighty. We have a crypto question. How should cryptocurrency transactions be reported on a tax return?
Yeah, so they get reported on Form 8949, which is the same as like stocks and bond transactions and things like that. So it counts as a capital gain for the most part.
Okay.
So here's the problem with crypto is that the IRS, in its infinite wisdom, decided that crypto is property. So effectively, it is the same as a lamp, or a desk, or a piece of land, or this hat that's right here on my desk. Uh, so all the same rules apply if you were to receive or purchase and sell, a lamp. Uh, However, crypto does not actually behave that way. Or I should say, it behaves that way in some cases, but not all. So there are people who just speculate on prices of cryptocurrencies. And if they're doing just that, then yeah, you buy, you sell, you have a basis, a proceeds, and whatever the difference is your capital gain or capital loss. Fine. However, some people receive cryptocurrency as payment. And then that is not a capital gain transaction. That is an ordinary income transaction. And that gets booked as revenue somewhere. And then, where it depends on what your business structure is. It could be a Schedule C, Line 1. It could be an 1120S. It could be 1065. It could be Schedule F. It could be Schedule E. It could be lots of places depending on how you are actually set up and what it is that you're doing. So that's another possibility. And then in a revenue event, so let's say I received one Ethereum, and Ethereum right now is trading at like $2,500. So I received one Ethereum today, and I have to book that as revenue of $2,500. And then 6 months goes by, and I sell that one Ethereum for $3,000. So now I have two transactions. I have a revenue event, and then I have a capital gains event later on. So I book the 2,500 as revenue with whatever entity that is creating revenue, and then the capital gains transaction is going to be reported as that $500 difference between when I received the currency and when I sold it. So that's a second situation of how it can be reported. And then we get into, and that's just like the two most basic things that could happen. Then there's more complications. Gets into smart contracts, NFTs, all kinds of things where just the concept of saying this is property kind of breaks down because things don't really work the same way. So there was an opinion piece put out back in March, I think it was, by the chief counsel of the IRS, and he was talking about NFTs, which NFT is non-fungible token, where you have a blockchain entry that represents something else. It could be a piece of artwork. It could be a fractional share of a company. It could be all kinds of things. And what the chief counsel said was that you have to do a look-through analysis, meaning that you can't just look at the NFT itself. You have to look at what the NFT represents and decide its tax treatment based on that. So, there were people talking about fractionalizing pieces of artwork and then contributing those pieces of artwork to museums to get charitable deduction. There was a couple of white papers going around about that, trying to gin up investor interest. So, it gets super complicated super quickly. And, if you're doing any kind of decentralized finance where you're in liquidity pools and, tokens are transferring automatically on your behalf, generating thousands of entries in a ledger, it can get way out of hand. There's GameFi. So the short answer is it's complicated, and how it's to be reported depends on what you're doing. And if you're just buying and selling, it acts just like a stock, although it doesn't have a wash sale exclusion, so that could be interesting to play with. But yeah, then it just goes up from there as far as how to report it on a tax return.
Right. So if you have questions, more questions about the crypto, come see
Yeah,
come see us.
yeah. I will tell people we do not do crypto bookkeeping because it's a giant pain. There are companies out there that do, and we can refer you to them. But it is just it is so painful. Uh, all right, so it is now 6:45, and usually I'll say this like the last 5 minutes, but I want to talk about more stuff today. So let me bring up my thing that I was looking at. So basically, there are new things afoot, and I sent out an email to some of our people, but we have two new things coming out. Well, actually, let me move forward to the next slide. Because the next steps is you should join our Tax Sherpa Explorers group. This is a free group that we have created, and you can submit questions to this Q&A. We're going to have discussions there. You can post anything you like about business, about tax, about all that kind of stuff. You're going to get free templates, tools, courses, all that kind of stuff. TaxSherpa.com/explorer. And our mission, as always, is to make more money and to keep it. So I wanted to take a second to kind of go around and show you this is actually our navigators, which is an advanced group. But it's a forum group, and we've already got a number of people in here. And the thing that really makes me excited about this is actually the learning portal. So I've already added a couple things in here. I'm going to be adding more and more over time. So one of the first things I added, actually the first thing I added was this course, Quick and Dirty Bookkeeping, because this is a constant problem. And it's a very short course. It'll show you how to do your bookkeeping in 5 minutes a month. And that only applies if you have a very simple one account kind of situation. But we get people all the time. So we had a client, this that we've been talking to for the past month or so on this issue. Uh, we said, hey, give us your financials for your company so we can file it. And he sent us bank statements. And it was like, yeah, we can't do that. We need actual financial statements because you had like $2 million worth of stuff flowing through this thing. You can't just wing it on the bank statement. You need actual financials. So in his case, even though he only had one account, that would be too complicated for this. But we had another client which actually generated this system, and they had a rental property. They bought like in November or something. They had two bank statements. And I said, okay, I'll just do this for you. Don't worry about it. And what I was able to do was I was able to create a custom AI solution where you upload your bank statement and it will analyze it for you, and then you copy and paste that into a Google Sheet that I've formatted out on your behalf, and then it'll generate a P&L for you. Now, it's not perfect. It's possible it can miss things, so you got to double check it, but it works for a simple situation. It will not do assets. It will not do depreciation. It will not do transfers very well. So if you have one account and there's just money coming in, money going out, it'll pick up most of the stuff. And it actually does a pretty good job of recognizing what expense category things apply to. So like I did one for myself, and it just as testing it out, and it picked up Facebook as ad spend, as advertising expense. So it was pretty cool that I was able to extract that information from the bank statement correctly, and then generated my P&L. And literally, you can do this in 5 minutes a month. And so, this is a resource that I'm making free for everybody, and just because it's a frustration for me, and I want people to be able to have the resources in order to move their business forward in a better way. And there's lots of things coming like this. So two other tools that I'm working on. So one is this book that I wrote this last little while. I'm calling it the Partnership Success Blueprint: 13 questions every entrepreneur should answer before signing a partnership agreement. And this is based on my experience of being in partnerships. I've been in four, really. Two were dismal failures. One was, we made some money and then we agreed to disband. And then the second one or the fourth one rather, is still ongoing and it's working fine. We're not making any money, but it's working out okay. But these are 13 questions that need to be addressed before you start whatever it is you're going to do. Because once you're in the thing and things start going wrong, it's too late in order to come up with a way to deal with stuff. I won't say in all cases, but majority of the time, it's too late because there's already hurt feelings and people aren't willing to communicate and all these kinds of things. So if you had these discussions on the front end, then you can avoid having difficulties on the back end. When these issues do actually end up popping up. So yeah, there's 13 of them to go through, and so there's an ebook, there's a checklist, and then I'm turning this all into a full-on course that will guide you through each of the 13 things rather than just the reading the book. So that's going to be going in the portal. Another thing I've been working on is a business design calculator. This I'm actually pretty excited about. So what this calculator is going to do, and right now it's a Google Sheet, but we'll see how that ends up, is that you create a target. You say, okay, I want my business to provide me with a lifestyle of whatever. So we could say $100,000, right? And then it starts to fill in stuff down below here. And then we put in our product and service mix. And so let's say we have two products. One is $100 and one is $500. And we'll say 75% of our customers choose the $100 and 30% choose the 500. Now you'll notice 75 plus 30 is more than 100, and that's okay because if you have clients that buy more than one thing, it can add up to more than 100%. So it calculates, it says, okay, based on that, your average sale is $225. So then it does some very basic business design considerations that says, okay, how much revenue do you need in order to generate a lifestyle spend of $100,000? And the answer in this case is $200,000. And how much of that $200,000 can you spend on business stuff? And the answer is 60. And of that 60, how much can you spend to acquire these customers who are buying this average sale of $225? And the answer is 40,000. So that leaves 20 for remaining OpEx. So all the other stuff, the software and the websites and the mailing, or not the mailings, that'd be acquisition costs. If you have to rent a place of business, all that stuff goes into OpEx. And then for a business this size, how many employees would you typically have? And it's either going to be 0 or 1 in most cases. How many of these $225 sales do we need in order to generate the $200,000? That is 889, and that or 74 a month. You should put aside 30 grand for taxes. You'll have 10 grand worth of profit over and above the 100,000, which puts your total owner cash flow at 110. And it's very rough, but it gets you like pretty quickly narrowed down and says, okay, if I'm thinking about starting this new thing, how much do I realistically want out of it, given the things that I'm selling? And will this structure work? So for example, if I need 889 sales and I've got $40,000 to spend, the most I can spend to acquire that is 40,000 divided by 889. I got to keep my acquisition cost at $45 or less. And if I can do that, then there's 900 people out there that's willing to buy my things, then yeah, this will work. And can I do that while only spending $20,000 on other stuff? And can I do that while it's just me? Those are questions that you can start to ask yourself when going through this kind of exercise. So I'm actually pretty excited about this whole thing. But it's going to go into our learning portal, which is this guy. So, the Explorers group is our home for basically everything that's Tax Sherpa is going to offer. So, like I said, templates, books, courses, other kinds of tools and frameworks. Because more and more, I find myself interested in getting people off of what I call step 0. So, step 0 is that step 0 is knowing where you are in business, because people talk to business coaches. I have business coaches, and the business coaches will often help you with strategies and tactics, right? So I have a goal. what's my strategy to achieve that goal? So like, marketing, for example, do I want to do email marketing? Do I want to do Facebook marketing? Do I want to, market on LinkedIn? Do I want to do Google ads? So those are all different strategies, right? And then within that, there's different tactics. It's like, okay, if I'm doing Facebook ads, do I want to do video ads? Do I want to do still ads? Do I want to do lead forms? Do I want to do Instagram targeting? Do I want to do, this, that, and the other? Those are all different tactics within the strategy of Facebook ads. But before you even talk about your strategies and your goals, you got to know where you are first. And I find so many entrepreneurs and small business people don't have the foggiest clue of where they are in their business right now. And so I'm spending a lot of time and effort trying to give people the tools to do that analysis. Because yeah, I mean, we could do it for you, but then you're going to be hiring us as like a fractional CFO, and it's going to cost you several $1,000s a month. So if you don't want to pay, $40,000 a year for this kind of stuff, whether it's to us or somebody else, then you have to be able to do this kind of analysis on your own. And if you're a small business, obviously it doesn't make any sense to pay those kinds of fees. But that is what it costs. For a fractional CFO, typical charges are going to be anywhere for a small business. Typical charges are going to be $3,000 to $10,000 a month, just industry wide. So if you're making $500,000 to $1 million, okay, that makes sense. If you're making above $1 million, you probably have somebody internally that's on staff full time doing your CFO work. But if you're under that, if you're under 500K, then it's really hard to justify that expense. So I want to be developing a lot of resources to have these small business owners be able to do this analysis themselves so that they can get off of step zero. So they can know where they are and say, okay, here's where we are now. Now I know that my goal should be X. And within X, we can do strategies 1, 2, 3. And within strategy 1, we can apply these different tactics. And you can do a lot of research on your own once you know what you need to look at, which is, just having that specificity is really helpful in terms of, figuring out what you need to know. Because, we're in a new economy. I mean, I know it's kind of a trite thing to say, but it is absolutely true. And there's new things happening all the time. New tactics are being created all the time. So even in an old industry like real estate, it's like, well, in the old days, there was commercial property, and then there was rental property, residential rental property. And then, over the past couple of years, we've seen short-term rentals become a thing. And even more recently, we've seen the return of medium-term rentals and pad splits and all these different techniques that have become popular over the last few years, as prices have gotten higher and higher. So, there's always something new to learn, but you have to focus your time and attention on the thing that is going to move the needle for you. And that starts with knowing what's going on right now. So, so lots of stuff coming down the pike in terms of tools and resources in order to figure that part out for yourself. So that's Tax Sherpa Explorers. It's going to be, I'm pretty excited about it, to be honest. We have a higher level community, which is the navigators, and that's basically you get everything. So, but that does have, a small monthly fee associated with it. But the Explorers is totally free. You can be a client or not a client, doesn't matter. There's no obligation to use us for anything. You can participate as much or as little as you like. But go ahead and go to taxsherpa.com/explorer, and that'll take you to the sign up page. Again, totally free. And I hope to see you guys in there. But with that, that brings us to the end of the hour. So we will do this all again next time at the 20th, I believe is next week. And we'll do lots more questions. And you can submit questions to this Q&A next week on the Tax Sherpa Explorers community. So hope to see you all then, and we'll see you next week.
Alrighty.